Data released today shows sales of new single-family homes rose to a 7-month high in December. That was a gain of 3.7%. It was better than estimated. Our next guest, though, says other indicators are pointing to a weakening economy. Certainly, we've seen some choppiness, at least. Joining us now is Michael Arone. He's State Street Global Advisors Chief Investment Strategist. So, Michael, we've seen, obviously, this rally this year that has now started to sort of stall out to some degree. The numbers today were strong. They were December numbers. But we have had this sort of unevenness to some degree in the economic data. Is it enough to propel us forward?
So I think what's happened is investors have priced in a tremendous amount of good news. So a U.S.-China trade agreement is baked in the cake, as is a Fed that's likely on hold for all of 2019. And I think asset prices and stock prices currently reflect that reality. So now what's interesting is what's that next catalyst as the bull market approaches its 10th birthday to get it going. And what's interesting is that the economic data has been mixed. So we saw the ISM manufacturing data last week came in with a miss. Consumer sentiment, as measured by the University of Michigan Consumer Sentiment Index, came in a little lower, has been trending lower. The NFIB, Small Business Optimism Index, has also been trending lower after reaching its high last August. So there's a number of indicators to suggest that the economy is having mixed results. Now, it doesn't mean we're headed towards recession, but definitely a slower U.S. economy. It seems like the U.S. is joining the global slowdown.
And yet, as we watch a bit of a pullback on the S&P 500 and Dow, you point out that 90% of S&P 500 stocks are trading above their 50-day moving average. So how do I reconcile that with what you've just said?
So as we know, the investors are basically discounting the future in terms of looking ahead. And I think what they're looking ahead towards is that the U.S.-China trade deal, as well as an easier Fed, will be that catalyst for better growth, better global trade, and a rebound in corporate earnings. What I'm saying is I'm just not so sure that that's, I think they're kind of looking at this through rose-colored glasses, and I'm not sure that's likely it's not the silver bullet that we would have expected kind of moving forward.
Tendayi, I want to get your take on the economic picture as well, given the data that we've had.
Yeah, so the great thing about the data being so mixed up is it's almost like those kids you had when you were a kid, those books, sorry, Pick Your Own Adventure. So you can kind of pick the data, that kind of, tells you the story that you think you believe. So I think if you want to argue the other side of it, you would look at, obviously, the labor market. You'd look at accelerating wage data the past couple of months. And we had a nice surprise with the GDP numbers where we saw a pop in investment, which at least I wasn't expecting. So I agree. It's really difficult to figure out where the economy is right now. And we also have the general muddiness that was introduced by the government shutdown, both in terms of actual economic activity and in terms of actually measuring the economic activity. So we're getting data that's been affected in terms of what was actually going on, and also affected in terms of how they measure it.
Well, here's a real-world data point that a lot of people can relate to, is the fact that the 30-year fixed-rate mortgage right now is at about 4.4%. It's down from where it was towards the end of 2018. With the Fed on hold, I would imagine that interest rate's going to stay flat, maybe even fall a little bit more.
Yeah, so I think that's actually what's flattering some of the housing data as of late. So as the 10-year Treasury has kind of lowered in yield, we've started to see a little bit of a rebound in the housing market. It's been pretty 2 steps forward, 1 step back, but overall, the fact that rates may begin to plateau could begin to help interest rate sensitive sectors like the housing market. And certainly the housing data today was better than expected, but still year over year was the slowest pace of gains we've seen since 2012. So again, it's that kind of mixed picture.
Michael Arone, good to have you here on The Move. We appreciate you joining us.
Thanks for putting it in perspective for us.